that's done by people like you and me. So regular mom and pop retail investors. I'm going to be focused on the role that these investors play in the stock market and whether or not they seem to tell us anything about the direction of stock price movements in the future. The conventional view, as Charles alluded to, the conventional view is that I think retail investors are not particularly well informed. In fact, there's considerable evidence over the last 20 years in academia and certainly anecdotal evidence on Wall Street that retail investors make all sorts of silly mistakes when they choose their portfolios. And so as a consequence, we know these investors don't diversify properly. We have evidence that they're overconfident, that they trade too much. So because of this conventional view, it's often been thought that if retail investors do affect stock prices, if anything, what they do is they tend to buy stocks that are overpriced and elevate their prices even further, distorting market prices away from their fundamental values. Now, the opposing view, I think it's a minority view, but perhaps a growing one, an opposing view is that there are at least some retail investors out there who might have information, genuine information, about firms' future prospects. They might be able to say something about what these firms are going to do in the future that maybe not all institutional investors are aware of. And now, if you think about why this would be the case, I think there are two main types of reasons. One type of reason is that, well, if you think about institutions managing money and investing it, institutions aren't managing their own money, they're managing somebody else's. So retail investors, at least their hearts should be in it because they're managing their own money, right? Now, beyond that, though, it's not enough, I think, to have just your heart in it. You also have to have some kind of access, presumably, to some type of information. Now, what type of information might retail investors have that institutions don't have? Well, I think they can have several different sources. One possible source is that they might have access to information through where they are physically. They may be near a firm. So geography may be one reason. They also might have access to information through where they work. They could be employees or no employees of a firm that they're thinking about examining. And so through their social network then, individuals might have superior information or at least complementary information to institutions. So in two papers in joint research with Eric Kelly at the University of Arizona, I've been studying whether or not retail investors do in fact possess novel information about stocks. And in this research, we've been focusing quite often on smaller stocks because I think it's more plausible to think that institutions, which tend to focus on larger stocks, stock analysts will tend to cover larger firms, buy-side institutions will tend to study those firms, those institutions might be ignoring the little guys. And if so, there could be plausibly retail investors who have information about smaller firms. Now, what would these retail investors look like? They may not be necessarily the typical retail investor. They may be slightly more sophisticated than the typical investor. How would we identify savvy retail investors? Well, one type of activity that retail investors don't usually engage in is something called short selling. So most of you are probably familiar with this idea. It's the idea that you can borrow a stock. If you think if the current stock price is high, you can borrow the stock and sell it out in the marketplace with the promise to buy it back later in the hopes that the price will fall. In the meantime, you'll profit from the decline in the price. Now, these retail investors that engage in this type of short selling activity are presumably more savvy. They know how to engage in short selling activity. They've signed up for a margin account at their brokerage. It's perhaps these types of retail investors that might be relatively well informed and may have some type of information that institutions don't seem to have. Now, we know very little about the success or failure of retail investors who short sell stocks. So what we're going to do, what Eric and I do in one of our papers, in the most recent one of these papers, is we look at whether or not retail short selling activity actually predicts future movements in stock prices. And the two main hypotheses are kind of this informed trader hypothesis that I've been alluding to, and the alternative hypothesis is this idea that mom and pop investors don't know what they're doing and might actually distort prices. Academics call this type of trading that distorts prices, they call it noise trading. So here are the two predictions from these theories, this noise trader theory and this informed investor theory. So what I've graphed here are stock prices, the path of stock prices, after a time in which retail short selling occurs. And according to the information theory, if you see retail investors betting that stock prices will go down, well, stock prices do indeed go down after retail short selling occurs. And moreover, they tend to stay down after retail short selling occurs because there's genuinely been bad news about the firm that these retail short sellers were predicting, according to this theory that's drawn in blue in the picture. The alternative hypothesis is, however, that retail investors, when they short sell a stock, they really don't know what they're doing. And if they don't know what they're doing, they might get fortunate and there might be a stock price decrease in the short run, perhaps as more and more short sellers pile into a stock. But in the long run, eventually, you should see the price bounce back, as these people were, after all, wrong and they didn't know what they were doing. So retail short selling shouldn't necessarily predict downward movements in prices. Maybe in the long run, it actually predicts just the opposite if these people are mistaken. So how do we go about testing this idea? Well, we're going to compare the returns of different types of stocks, depending upon whether retail short sellers heavily short sell a stock, or whether they don't short sell it very much, so heavily shorted versus lightly shorted stocks. And the advantage of this methodology is that we're going to be able to eliminate the impact of overall market movements by comparing these two sets of stocks, because both should be similarly affected by the market, all else equal. We'll, of course, control for various measures of how risky the different stocks are when we compare returns. Using conventional models in academia and industry, we're going to focus on using the French model for those who are familiar with it. And the point will be to see, do the stocks that retail investors short sell, do they actually have poor performance after short selling occurs? Not only are we going to look at returns, though, we're also going to try to say something about the type of information that's released about stocks after short selling occurs. If our hypothesis is right and that some retail investors actually have information, what we should see is that that information eventually comes to light. Now, how might it come to light? How might it become public? Well, we're going to look at news stories about different firms. We're going to ask whether or not there's more negative news. There tends to be more negative news after you see heavy short selling activity by retail investors. It's as if then they would predict the negativity of the news. We're going to measure the negativity of news by using a textual analysis where we count different types of words, negative and positive words. So the tricky part about this project, one of the tricky parts, is getting data. It's really hard, it turns out, to get data on retail investors, especially in the United States. Other countries are a little bit more forthcoming. Scandinavian countries tend to be a little bit more open about these things. But we're trying to look in the United States, so we get data from two large over-the-counter market makers. From 2003 to 2007, we were fortunate enough to get this data. And these market makers cater to retail investors. In fact, dozens of big retail brokerages route their orders to these market makers. How many orders do we have in our database? Well, we have about $2.6 trillion worth of trading volume and about 200 million different executed orders in the database. Now, most of these, this is, by the way, roughly 1/3 of all trades by retail investors in the United States. Now, most of these orders are not short sales. As I said, short sales are pretty rare. Only about 6% of them by dollar volume are short sales. The short sales look a little bit different from other types of trades. As I said, maybe retail short sellers are a little bit different. How are they different? Well, one thing right off the bat is the average trade size seems to be quite a bit larger for short sales versus other types of trades. It's about twice as large for short sales. So maybe they're more confident or maybe they're wealthier, but whatever the reason, these investors seem to be a little different from others. Now, what we're going to do empirically is we're going to look at short selling activity in a given stock in a given week and ask what happens after there's been heavy short selling in a week versus light short selling. Compare different types of stocks. Here's a picture showing what we're going to find, what we find empirically. So we group stocks into 5 different groups according to this time right here, which is essentially the 1 week period where we measure retail short selling, days -5 to -1 in this picture. And then what we do is we sort them according to the ones that are most shorted, which is the light blue line right here, versus the ones that are least shorted, which is the heavy blue line, the dark blue line on top. And the ones that are most heavily shorted, it turns out, they've done very well prior to the time in which retail short selling occurs. It seems like retail short sellers are betting against stocks that have been going up. But what happens after? This is the really interesting part. It turns out that the cumulative returns, when you adjust for risk and stuff like that, the cumulative returns of these stocks are about 1.5% negative over the next 60 trading days. Now compare those returns to the returns of the stocks that were lightly shorted, and what you see is those stocks actually, if anything, go up. So it seems then that the retail short sellers, according to this picture, are at least right in the sense that the heavily shorted stocks do perform worse than the lightly shorted stocks. And there's a monotonic relationship depending upon how high short selling was during this week. The ones with the highest do the worst, the ones with the next highest do the next worst, etc., etc. So what we're going to do now is we're going to see whether this relationship actually persists over a longer time frame. So this is just 60 trading days, going out to about 3 months. This is now just the difference between two of the lines that I showed you in the previous picture. So I'm going to focus now on the heavily shorted stocks right here versus the lightly shorted stocks, and just take the difference between those two lines in this picture. This is the performance of the heavily minus lightly shorted stocks here. And qualitatively, it looks a lot like this line over here. The main difference is going to be that now the scale has changed. This goes out to a full year after short selling activity. And as you can see from this, there's really no sign of reversal of this pattern when you stretch it out to a year. So what I previously showed you was just inside this box right here, but looking inside the box and outside the box, you really see the same picture, essentially. What we're going to focus on for the rest of the talk is going to be just this period right here in the 1 month after retail short selling activity, because it tends to be the case that short sellers have relatively short time horizons of about a month, and we have most statistical power to examine what goes on here. But bear in mind that if I stretch out the picture, it's going to look very similar. So now, which types of stocks do retail short sellers have the most success in? I suggested to you earlier that it might be the case that they predominantly have success in small stocks that tend to be overlooked by institutions. So here's a breakdown of the annualized returns of this strategy that essentially mimics the activity of retail short sellers. I'm going to look within this window here and show the annualized returns of that trading strategy right here. So in which types of stocks do retail short sellers most effectively predict returns? Is what I'm trying to ask here. And it tends to be the case that if you break stocks down by the size of the stock, as measured by the market capitalization, what you find is that the stocks that have the smallest size, which are in quintile 1, the smallest 20% of stocks, over here, are where the retail short sellers have the greatest success. They have a decent amount of success in the next smallest group and the next smallest group, and even in one of the larger groups of stocks, quintile 4 here. But when you get up to size quintile 5, you're essentially talking about the S&P 500 stocks, the largest stocks that are out there in the United States. Here, retail short sellers seem to have virtually no ability whatsoever to predict returns. So it does tend to be the case that the smallest stocks are the ones that they seem to be most informed about, according to this measure. So summary of what we found here so far. Retail shorting negatively seems to predict returns. It's a fairly large magnitude if you measure this. On a monthly basis, it's about 0.75% per month, or about 9% annualized. So these are decent magnitudes. The largest effect is in small stocks. Now what I want to think about is what might these retail short sellers actually know? And is there any evidence beyond just looking at stock returns that these people are informed? Now let's look at the news that occurs for different stocks. So what we do to examine the tone of news stories, as I suggested earlier, is to do a textual analysis of news stories about each different firm that's traded in the stock market. And we analyze the fraction of different words about each firm that are negative according to psychological dictionaries. And the higher that fraction of negative words is, the more we say there's negative news about a firm. We measure the negativity of news 2 to 20 days after retail short selling activity, 21 to 40 days, and 41 to 60 days. We focus on news that we think is going to be generally important, such as news about firm earnings. We also use other different measures of news tone that are not just based on negative words, but another measure created by a company called Ravenpack, and Ravenpack actually specializes in classifying the news tone of different stories, both for institutions and for other customers. Our main finding from these tests is that we actually find retail short selling activity does very strongly negatively predict the tone of news. So there is more negative news that comes out about firms that retail short sellers seem to be trading in. Now here's a graph of exactly how negative the news tone is. This is the negativity of news tone after a change in retail shorting activity. So what we see here is that there's about a 3% increase in the negativity of news tone in days 2 to 20 after retail short selling activity, about a 3% increase in the next month, and the increase dips down to about 2% in the following month. And this is true for the other measure of tone as well. The other measure of tone is categorized differently, so it's not focusing on negative tone, it's focusing on positive tone, so you see the opposite sign there for that measure. But in both cases, the point remains that the more short selling activity by retail investors, the more negative the news tone. So it does seem that these people actually have some type of information that they're acting on when they trade. So the key finding from the paper, I think, is this idea that there are some informed individual investors out there, in particular the ones who engage in short selling activity. They seem to not only be able to predict what happens to stock prices, but also the type of things that appear in the news about different firms. So remaining questions, I think, are still numerous from this work. One big question is, what's really different about these retail investors that we're looking at as compared to the mom and pop investors that seem to exhibit all these behavioral biases? Are they paying more attention to financial markets? Are they maybe more financially literate? Or do they simply just have better access to information through their social network? And ultimately, how do these people obtain their information? Is this something kind of nefarious in the sense that they're getting their information from insider sources that perhaps is illegal? Or is this more a wisdom of crowd story? And that each of these retail short sellers really has a small piece of information, but if you aggregate all that information up into a large group of retail short sellers, there's actually quite a bit of collective information in the crowd. Thanks very much.